Level 1, the discovery. The $500 account, you buy a call option on a Tuesday night. You don't fully understand what you bought, you understood enough. You understood that if the stock moves up, the option moves more. That word, more, is the most dangerous word in finance, and nobody warns you about it at level 1 because at level 1 it sounds like opportunity. The option expires worthless. You lost $127 in 4 days. Not because the stock went down, because it didn't go up fast enough. You didn't know that was possible. You thought you just needed to be right about the direction. You were right about the direction. You lost anyway. You sit with that for a long time. Then you open another position. Not because you're reckless, because that specific feeling, being right about something and still losing, is a question your mind won't stop asking until it finds the answer. That question is going to cost you more than you're ready to calculate right now. Level 2, the sell side desk, $200,000. You are an analyst on a derivatives desk at a major investment bank. Not Goldman yet. Somewhere real, somewhere that matters, somewhere whose name makes your parents stop asking follow up questions. You do not trade, you build models, you run Greeks. You check positions at 6 a.m. before the desk arrives, and you're still there when it empties at 10 p.m., and sometimes you're there after that. Your hourly rate, if you calculated it, would make you feel something you don't have time to feel. What you have instead is proximity. You are close enough to the mathematics to feel its weight, close enough to the traders to watch what they watch, close enough to the positions to understand that what moves on your screen is not a number. It is a living calculation of every participant's simultaneous beliefs about the future expressed in real time with real consequences. You learn the Greeks, not as formulas, as forces. Delta is direction. Gamma is acceleration. Vega is the market's fear. Theta is time eating your position from the inside while you sleep. You are not sleeping much. Your girlfriend asked where you've been. You say work. She knows that. She meant something else. You both know you didn't answer the question she actually asked. You don't have the language yet for what this place is doing to the person she's asking about. The bonus hits. Total compensation, $200,000 to $300,000. You are 24 years old. The number feels like arrival. It is not arrival, it is orientation. Level 3, the junior trader. $400,000. You are touching the positions now, not running them. Supporting the senior trader, executing smaller pieces, managing the hedge on specific segments of the book. But your hands are on it. When it moves, you feel it. The first time a large position moves against you in real size, you feel it somewhere below the sternum. Not panic. Panic is loud. This is quieter than panic and more permanent. This is your nervous system recalibrating around a new kind of information. You are beginning to understand what derivatives actually are. They are not instruments. They are agreements about the future, priced by models, traded by humans, and capable of moving in ways that exceed what the underlying asset could ever do on its own. The leverage doesn't just amplify gains. You knew that intellectually. Now you know it physically. There is a difference between knowing something and having it demonstrated to you by a position that moved 40% in 20 minutes because someone printed a number that was 2 basis points from consensus. You close the position, you are flat, you sit very still. Then you open the model and figure out what you missed. That is growth, that specific response, not panic, not revenge trading, just sitting down and doing the work is the thing that separates the people who last from the people who don't. You don't know that yet. You just know you need to understand what happened. Compensation, $300,000 to $500,000. The number has stopped surprising you. That is the first thing you've lost that you haven't noticed losing. Level 4, the prop firm, $700,000. You leave the bank, this surprises people. The bank is the destination. Everyone wants in. You are walking out. You join a proprietary trading firm. The name is not on financial news. The people inside it are not interested in being on financial news. This world is different in ways that matter immediately. No clients, no corporate hierarchy performing itself in glass conference rooms. No politics to hide behind when a position goes wrong. Just capital, mathematics, and outcome. The firm's money is on the line. Your career is on the line. Every single day, those two facts sit next to each other and neither of them blinks. You are not trading the market here. You understand this within the first month. You are trading other people's models of the market. The edge is not knowing where the price will go. The edge is knowing where other participants' models will force them to go when conditions change. You are one level of abstraction above where you were at the bank. The mathematics required to operate at that level is different in kind, not just degree. You have 3 losing weeks in a row. Not catastrophic. Consistent in a way that means something. You are doing something wrong at a repeatable level, and you don't know what it is yet. That specific uncertainty, skilled enough to know you're wrong, not skilled enough to know why, is the most dangerous place in this entire journey. You find it, you fix it, you move forward. Compensation, $500,000 to $1 million in a strong year. You have stopped telling people what you do at dinner. Not because of secrecy, because the explanation requires context nobody has, and you've gotten tired of watching people nod without understanding. Level 5, the book runner, $2 million. You run your own book. The responsibility is total. The mathematics required to hold it correctly is at the edge of what a human mind can track simultaneously. Delta, neutral across multiple underlyings. Gamma exposure that changes shape as the market moves. Vega term structure that behaves differently in different volatility regimes. Correlation risk that only becomes visible when correlations break. You manage all of it in real time. While the market moves, you have a risk limit. You have approached it twice in ways that required decisions made in seconds that you thought about for weeks afterward. Not because you made the wrong decision, because the margin between the right decision and the wrong one was thinner than anyone outside this room would believe, and you were the only person in the room when it happened. You have developed what you call discipline, and what a psychologist would call dissociation. The ability to feel the position moving against you and continue thinking clearly. To feel the gamma accelerating and not let the feeling become the decision. You built this over years of smaller moments that hurt less but cost the same thing each time. A piece of whatever you were before, this was your whole life. Your relationship ended. Not dramatically. She said you were somewhere else even when you were in the room. You didn't argue because she was right. There wasn't anything to say after that. You think about it sometimes in the seconds between one position closing and the next setup forming. Then the setup forms. Compensation $1 million to $3 million. The number has completely dissociated from any felt sense of money. It is a score. The game is the thing. The score just tells you if you're still in it. Level 6, the hedge fund. $5 million. The capital is larger. The mandate is broader. The investors are sovereign wealth funds, pension funds, family offices, the people who used to be clients of the bank you worked at a decade ago. Now, they are your LPs. The relationship has inverted, and with it, something in your psychology has inverted too. You manage a derivatives book whose notional value exceeds anything you ran at the prop firm by a factor that still occasionally surprises you when you look at the aggregate exposure report in the morning. You have a risk manager, someone whose job is to tell you no. This is the most important professional relationship you have, and the most adversarial. They see the book differently than you do. They see it as exposure to be managed. You see it as a position with a thesis. Both of you are right. The tension between those two correct things is what keeps the fund functioning. You understand this intellectually. It does not make the conversations easier. You build a position. It is layered across multiple underlyings, multiple expiries, constructed so that specific volatility scenarios generate asymmetric returns, while defined risk limits contain the downside. It takes 3 weeks to build. It requires constant adjustment as the market moves. You are the only person in the organization who fully understands every layer of it simultaneously. That should feel like power. Sometimes it does. More often, it feels like being alone in a room with something large that is also, in some way you can't precisely articulate, alive. The position performs, you close it over 2 weeks. The P&L is the best single trade of your career. You feel nothing. You open the next model. That is not performance. That is not discipline for the camera. You genuinely feel nothing. And somewhere underneath the nothing, you understand that the absence of feeling is itself the cost you've been paying in installments since that first option expired worthless on a Tuesday night. Compensation, $3 million to $10 million in strong years. You have a security detail when you travel to certain markets. You did not seek this. It was recommended. You accepted it the way you accept everything now, as a variable in the operational structure, not as a fact about your life. Level 7, the architect. $15 million. You don't place most of the trades yourself anymore. You built the system. The system runs. Junior traders execute within the framework you defined. The risk manager monitors against the limits you set. The quant researchers refine the models you designed. You review. You approve the significant decisions. You are the decision layer above the decisions. This took years to trust. The first month you stepped back from direct execution, you watched every trade from a remove and felt the specific anxiety of someone who has handed the wheel to another person and cannot stop reaching for it. You gave it time. You reviewed the outcomes. The execution was clean. You adjusted twice. By month 4, you were reviewing end of day, not tick by tick. That was hard. That was necessary. That is what this level costs. You understand something now that you couldn't have understood at any earlier level. The derivatives market is not a mechanism. It is a collection of models built by humans interacting with other models built by humans, all of them simultaneously trying to predict what the other models will do. None of them fully visible to the others, all of them capable of being wrong in the same direction at the same time. You have read about 1998. You have read about 2008. You understand that those events were not anomalies. They are features. The system is complex enough to surprise itself. Your models are correct in every condition you have data for. You think about that sentence sometimes. The part that matters is the end of it. Compensation $10 million to $20 million in strong years. Your social world has contracted to a radius containing almost nobody. You tell yourself it's necessary. You've been saying that since the prop firm. Level 8, the apex. The office is quiet. Not late. It's mid-afternoon on a Wednesday, and you've already finished the only call you had today. You manage positions whose notional value affects price discovery in the markets you trade. When you move, others watch. When you pull back, the move is visible in the tape before anyone writes about it. You have become part of the machine you used to just watch. The mathematics that consumed 2 decades is now something other people execute on your behalf. You trust the system because you built it. You fear the system because you understand what it can do in conditions it wasn't built for. That tension, trust and fear, held simultaneously without resolving either, is the permanent psychological state of operating at this level. You stopped fighting it a long time ago. You think about the first option sometimes, not with nostalgia, with the recognition of a variable that's no longer in the equation. The feeling of that trade, the leverage revealing itself for the first time. The almost physical shock of something moving more than it should have been able to move. That was possible because the mathematics was still a secret and the stakes were still comprehensible, and you were fully present in the uncertainty. You are never uncertain anymore. That is the real cost. Not the relationships, not the years, not the version of yourself who opened that first options account on a phone on a Tuesday night and thought the downside was what you paid for the contract. The absence of uncertainty, the flattening of possibility into probability, the fact that nothing this market does tomorrow will make you feel the way that first position made you feel. The market opens. You watch the first few minutes without touching anything. Old habit. You've been doing it so long, it's not discipline anymore. It's reflex. Muscle memory laid down over years of loss and recovery, and slow grinding comprehension of something that cannot be fully comprehended. Somewhere right now, someone is opening an options account for the first time. They just bought a call option. They don't know what delta means yet. They think the upside is unlimited and the downside is what they paid for the contract. They are half right. The half they're wrong about will cost them more than they're ready to calculate. You know this. Not because you're smarter than they are, because you were them. The screen flickers. You place the order. Somewhere, someone just bought their first option. They think it's simple. They're wrong, but they'll learn.